Live at 5. Guess what, everybody? It's the happy hour today, right? So I'm Dan Weisskopf, the ETF professor, and we are crazy pumped today with the news about BlackRock filing for a Bitcoin ETF. Maybe a shocker for some, not for us. Anyway, welcome everybody. Live at 5, happy hour. And with that, I'm going to hand it off to David.
How's it going, everyone? David Chikansky here, fellow portfolio manager in the Title Financial Group. I focus on growth companies in the SoFi Be Your Own Boss Gig Economy ETF, BYOB, as well as inflationary pressures through the Amplify Inflation Fighting ETF, IWIN. I'll pass it off to Cynthia Murphy.
Hey guys, Cynthia Murphy, head of research for the ETF Think Tank. If you haven't noticed, the theme today is wear a hat for Thomas, who never is without his hat. So it's even more in jumped in. So very cool, guys. Good to see everybody. Mike, you go next and then introduce Thomas for us.
Absolutely. So exciting day. I was actually on Thomas's show earlier today with our client, Bob Elliott, and some other prospective clients and some other friends. So we've kind of been talking on and off all day. We've had a fun pre-show already since there was the breaking news with BlackRock, and we got to joke about that. Logistics, if you got something you want to share, put it in the chat or in the questions. If you want to get promoted up to come be a panelist and talk with us, please do. We always like to have an engaging, fun time, so we tend to have a drinking word. Today, it's going to be disruption. So with that, I'm going to give the little bit of disclaimer. Right now, Thomas and his company own a ETF that's ticker GRZZ. It's actually going to be moving over to our trust, and we're changing the ticker, not the name, but the ticker is going to change to DARP, which was a Meb Faber idea, disruption at a reasonable price, instead of some other funds that we're aware of that do disruption at any price.
Right.
So
unnamed.
unnamed. But that's the future. And so since all that news is now in the public sphere and the process is taking place, and sometime in August, they'll be over here and part of the family, we wanted to introduce them. And with that, disruption, and go ahead, tell us.
Yeah, there we go. There. It's a good drinking word, Mike, and the Title family. Thank you guys so much. We're very excited to join the team, and yeah, really, I can't be more thrilled, and it's just exciting to be a part of something dynamic, and hearing all the great ideas. Just we had Bob on this morning. It was great, and I learned a ton. So we had Mike on. Our conference was big. It was hard money, gold, silver, Bitcoin, and it's always great, right? Because you're learning a ton, and I didn't know how leveraged the block ETF was genuinely to Bitcoin, because you see all these names, but you don't really know the underlying, what's kicking in it, right? So I was something like that. That was pretty dynamic, but a pleasure. And maybe I'll just give a little bit of background. I'm not sure if Scott's on. Scott's actually, so he's Philadelphia based, my partner. He was driving back from Toronto to Philly, so he may be on the call on audio. But I'll speak for the both of us. We basically started Grizzle. We were both institutional. So I was at TD Asset Management in Canada. That's one of the larger, it would be the largest institutional asset manager in Canada. And I kind of career guy, you know what I mean? One of these situations where it was a fantastic time. I learned a lot about the commodity markets, a lot about growth. And we just had, Scott and I kind of put our heads together and said, listen, we could do this, great, or we could take a risk and tell our story the way we want to tell the story, and that was through the Grizzle megaphone, and that was 5 years ago, and that was kind of what started the whole thing. We were like, listen, let's start to cover cannabis. It was an emerging growth disruptive sector. We thought the coverage was all terrible, and we said we could do it better. And our first report was Up in Smoke, the overvalued haze of Canadian pot stocks. I never thought I literally, we were getting death threats from Reddit. It was brutal. I was like, Scott, why do we have our address on the website? This is not good. Like, I was like this, like, you know what I mean? To go from a cubicle to being like Reddit guys being like, I know what you do, hedge fund, evil guy. I'm like, listen, no, we're just a report. I know, like I don't know what. Like, there's like literally, we're just putting out data. And I was like, this is crazy. I'm like, take the address off the website. But needless to say, no pipe bomb came through the office. It was, you know, we got through that. We did subsequently get proven correct, but you never win medals for being proven correct when things go down. You're always just, you know, a small little, like, you know, like racing car token. That's it. But that, you know, that kind of spurred what we did, and then, you know, then we started to cover alt meat, faux meat, if you will, plant-based meat in Beyond Meat. That was a big one for us. We were early on that. We caught that. And then Scott covered all of the big tech IPOs, and you know, we've just been riding the disruption train. And, you know, the most recent stop, of course, is AI. But leave it at that. Just kind of a little bit of a background about Grizzle and our little journey here into our ETF, plus joining the Tidal family. So very thrilled to be part of this.
All right, who wants to pitch first?
I think that, you know, from death threats to BlackRock filing for a Bitcoin ETF, let's just go straight there.
That's right.
All right, let's start with crypto, man. That's definitely a disruptive technology. I guess instead of crypto, let's talk about what the news that just hit, right?
How can they do that?
I mean, it's a pretty surprise, right? Like, I mean,
BlackRock
David's
is 17th in line to file for a physical Bitcoin ETF. An institution of that size that really wouldn't be 17th in line unless they had some sort of information that they know they might actually pass it through. 2 weeks after the government declared war on crypto. So we were pontificating before the call. What is the likelihood of, like, the announcement that BlackRock then purchases Coinbase, as our ETF professor was alluding to? All of BlackRock's physical Bitcoin is held on Coinbase, which the government is now at war at, but can approve BlackRock as an institutional account. So Thomas, your thoughts on all of that above? Let's hear it.
Hold crypto coins. I was just typing that.
Is he freezing, or is it just me?
Yeah. So obviously, you know, I'm going to put on my conspiracy hat. I'm where hopefully it says my internet connection is unstable. Hopefully that's better now. But I'm going to put on my conspiracy hat. And I would say that this is feeding the frenzy of insider ball, classic BlackRock. Like, there's already half the country that believes BlackRock controls the world, right? Like, you know, like, it's just like, and now you're giving them this. It's I don't get it, right? Now, like, David, to your point, would BlackRock do this knowing that they would be the umpteenth or 18th, you know, Bitcoin ETF to be denied? I don't think, you know, knowing, you know, given where they sit, it would be ridiculous. But that just would be such a slap in the face to decency, and you know, it just would be wrong. It'd be wrong. Like, but that all being said, loving a good headline, I think we would run Twitter Spaces on this, because we do that for quite some time. It just would push more people into Bitcoin, and you know. So let me give you a little background. I ran a precious metals fund, and my biggest thing was like, listen, you can't own these you can't own GLD. Let me tell you, that paper stuff, it's not good. That paper gold, that, like, people will say whatever BlackRock has, there's no real BTC underneath, right? You'll get that conspiracy. It's not real. And the real stuff you own is, you own either mining companies, or you own something like, Fort Knox, like, or, you know, whatever, Sprott, or, you know, some one of these like real kind of end of the earther kind of firms, right? Saying, you know, they have the gold and here's the verification, whatever, right? But it would be curious to see how the market, the broad, I would say Bitcoin maxi market, takes that.
Yeah, I'm pretty sure they're not going to be happy.
No.
They're not going to. But
hey, can you guys hear me? It's Scott here.
Hey, Scott, welcome aboard.
Oh, hey,
Scott.
We're here. You're driving.
Yeah, I'm going to get the best barbecue north of the Mason-Dixon line, but for right now, I'm chilling with you guys.
Awesome.
What's the name of it, Scott?
Dinosaur barbecue.
It is very good. I've had dinosaur barbecue. Like Scott recommended it. It's incredible.
Yeah,
So
I mean,
this is not part of the faux meat craze thing that you were talking about earlier, right?
no, this is very traditional. The same meat we've been eating for 1,000 years. That type of meat.
Well,
but I wanted to weigh in on the Bitcoin question. I'm wondering if BlackRock thinks that this may take a little while, and so with everything going on with government cracking down, we may end up getting clarity on the route forward. So they think they'll get clarity, they'll be moved up in line, and then maybe they can be like head of the pack to get something actually approved. I'm just kind of spitballing.
Yeah, so I can chime in on regulation here, because since we do work with Hashdex and Tucrium on a futures version, the only 33 Act futures version with the ticker DeFi. So we've done a lot of work here. The reality is, if everything goes right, it's at least 240 days from them launching. That's if everything goes right, because a 33 Act fund works very, very different than a 40 Act fund. Now it's the proper structure. There'll never be a 40 Act Bitcoin ETF unless Gary Gensler decides it's a security, because a commodity can't be held as the main asset in a 40 Act fund, right? That's why BitO and some of these others, they're futures based, but they're doing it through a Cayman sub, and they're basically owning cash for the bulk of the portfolio. Now, a Cayman sub can only be up to 25%, so a 40 Act could never be more than 25% physical. Now, the strange thing is, for some reason, a law from 1933 that's 90 years old governs that this is going to take at least 240 days. How a law that is 90 years old is dealing with a technology that's 10 years old or 20 years old is absurd, but it is where we are. It certainly doesn't sound like innovation or disruption, especially when BlackRock is the one coming in. But when we did the hard money today, you guys talked a lot about, and I watched some of the others, and I talked to Tracy and Greg, the similarities between Bitcoin and gold. Now, a year ago or a year and a half ago, right when COVID started to break and vaccines and all that shit, Guyad and I got invited to come speak at the Money Show. Okay. And I don't know how many of you have ever been to a Money Show event. There are people in tuxedos, and then there are people in overalls. And it is an eclectic crowd. So I was asked to speak at the Bitcoin versus gold debate. And it's funny, like they had this guy, Adrian something, he worked for Schiff. And there was this whole thing where he just like attacked Bitcoin. And I got up and I said, own both. And also he gave this whole speech about how Bitcoin, you can be, it's not safe and this and that. And when he walked past me, I stole the gold coin that he used as an example that it's hard. And I put it in my pocket and I held it up and I said, here's my phone. Can you steal my Bitcoin? He goes, no. I said, well, I already stole your gold, but that's neither here nor there. What I think is interesting is we're finally getting to that point where you do have like a meeting of the minds of the Bitcoin maxis and the gold bugs. Yes. And I think it's because Gensler is forcing everybody to become a Bitcoin maxi. So I don't know. Talk to what you guys talked about today, man.
No. And I'll let Scott add after. I thought it was completely illuminating. It was like, it really was, you really had a big tent. The gold, I would say it's more on the gold precious metal side. So just an FYI, right? In Canada, Sprott is kind of like, very well known on the, on the end to earther kind of like own physical commodity kind of thing, right? And they've been a partner for us for our conferences. And anyways, just to by the by, we said, hey, listen, we're doing a gold Bitcoin conference. It's going to be hard money, and they're like, yeah, I can't do that. And I said, I'm like, listen, you can't leave a generation out. Like, that's not a good look for you. He's like, yeah, we kind of made that bet. I'm like, you kind of, I said, listen, you want to revisit that, right? Because, he was, listen, we know who buys gold that are old and, gray hair and all that sort of stuff. And I said, so it was an interesting take from one of the biggest players in physical gold in Canada, and if not the world, right? And it's very kind of dominated here, Eric Sprott and the like. But I just thought today was very dynamic. Coming to your point, Mike, it just was like big tent, really talking about the similarities here, and it just feels that both are getting their points across saliently, and stuff that feeds the dynamic of conspiracy is a tailwind for Bitcoin and gold.
Well, we're not lacking in conspiracy theories lately.
No.
I don't have my tinfoil hat. I just have my Psycho Buddy hat. All right, so let's jump from crypto gold to Scott and Thomas. What's the most interesting disruption you guys are seeing right now? And you don't have to say AI, but it wouldn't surprise me.
Yeah, well, it's like I hate to be on that side. So let me give you let me give you the first call, which is
Tom. You do New World, and I'll do Old World or Old World disruption.
Right? Yeah, good. And so we specialize in the barbell. And our view is that there is disruption happening in two worlds: the technological world and the physical world, right? And the physical world moves at a different pace, of course, but the dynamics there. So all of the physical commodities that feed into the technologies, that propel the future, lithium, et cetera, copper, they've been underfed. And we also believe that natural gas is the greatest disruptive. And people say, well, it's disruptive. Well, no, like if we are going to get to a world that has less carbon emissions, like I still remember landing in New Delhi, like it's just a mess. Like going into any Asian country is just a mess. And you can definitively point to coal power generation for that mess, right? And we just believe that the combination of lithium, copper, electric metals, that electric metal family, plus natural gas, that's one part of the pillar, and then the other side of the pillar is technological, which a lot of different aspects there. We would truly say, and I know it's kind of at this point right now, it feels like consensus, but I still don't think we are anywhere near consensus. AI, it just genuinely, we had our aha moment. We were heavily weighted into Microsoft to start the year. And we still are. 15% of the portfolio is in Microsoft. And, we just said, hey, listen, this chat, Scott used it, I used it. We're blown away to the point, it's incorporated in what we do. But then, we were always hesitant on chips, just in the sense of commoditization, et cetera. And then, we understood, we truly got to understanding, where NVIDIA stood. And we said, listen, there's no question, we have to own this in size. So our perspective is that picks and shovels matter a ton. And those that have the product and are embedded in everyone's daily lives, like Microsoft, have the advantage, right? And that's just one level, one aspect of it. We also, we're also with respect to the broader technological world, we also own Adobe, and I think after hours, they had good earnings, and we just believe that incumbents really do have an advantage in that space. And now I'll pass it over to Scott to talk about the other side of the pillar.
Yeah, I think Tom covered really well. AI is still in flux. It's moving so fast. We don't exactly know what some other themes will be that are going to make investors a lot of money. What we've identified so far is the picks and shovels. This basically is probably going to lead to a big CapEx boom in processors. So NVIDIA's picks and shovels, they built kind of a moat in, ease of use and the ecosystem, how many people use NVIDIA. AMD is coming out with their own AI training chip. So that's being hyped as well. But then, the barbell is important to us because there's the big incumbents. They already have so many advantages. It's really theirs to lose. So what we've seen in the past, when regulators don't step in, you have a disruptive company coming up. Well, then the big guy ends up buying them, like what Meta's done and Apple and all these guys. As long as regulators aren't really on top of them, and it seems like most of them besides Meta are generally under the radar, they've still been able to do some deals. That's why we play both of them, because it's theirs to lose. And then you will still own that disruptive guy anyway, without having to play and say, I'm going to take a lot of risk and buy that startup. And, 9 out of 10 of them may fail, but I know the one. Instead, you can, do lower risk, lower volatility, still own it at the end of the day, just a little bit farther along the curve. That's kind of how our process works. It's not go for the home runs with unknown risks.
Yeah, I think Scott really nailed it. I think one thing we failed to do is talk about DARP and what DARP is, a disruption at a reasonable price. And we really do emphasize that. And what is at a reasonable price? We were owning Facebook at the start of the year in size, Microsoft in size, and in addition to Google. These were very, very unloved, what we'd call value names that still had real growth trajectory. And that to us was real sweet spot DARP. We did a TikTok, Twitter video on it. We're like, listen, these are the cheapest, like literally Facebook was the cheapest it's ever traded. And that to us was like, listen, this is not for dead. Zuckerberg, if he may have been misguided on a meta trip, whatever he was on. But man's a killer though. Listen, I can count him out for a round or two, but not the whole fight. Not Zuckerberg.
I like Slack. I think Slack's a good example of what can happen where they created something novel that was pretty cool. And once we found it, we were like, oh man, email's dead. We started using it. We've incorporated it fully, but they just couldn't beat Microsoft because Microsoft had so many resources and built-in user base. They just said, all right, we're going to make something similar. We're going to shove it down everyone's throats. A lot of people are going to use it. And then Slack just had to be sold to, what's the name of the company, Tom? I'm blanking on the name of the company.
Oh, yeah.
Slack.
Gosh. I just
saw a West Coast company, Mark Benioff's company.
Yeah. Salesforce.
CRM.
So that type
Salesforce.
of thing. Yeah.
Salesforce.
Yeah. So I think that'll happen again. That's just the risk you take. You can be this like hot, cool new company, but at the end of the day, you have to sell your software to people. And so if you go up against one of these juggernauts and they can just copy your software and they have all these customers already, that can happen. So that's why we own the barbell instead of just saying the incumbent's not only going to win on like technology, but they're going to win the market too and disrupt those big guys. That bet is uncertain to us. So we still we bet on the big guys with the barbell of the smaller disruptive ones, and we really have conviction.
Yeah,
so
go ahead. Sorry.
So guys, speaking of disruption, in old guard, you're long some energy names, and particularly Nextera, I'm curious about because there's a lot of conversations. I don't know if you're aware about the energy companies taking over the crypto mining companies, right? And Nextera is a great example of that, where they're investing in that space.
Wow.
And it could be really powerful if they get aggressive because, crypto mining, one of the highest cost components is energy.
You're right on. Yeah. No, that's a great point. Now, so Nextera for us has always been, in our view, one of the absolute leaders in U.S. utilities, right? In U.S. utilities is always slept on, always forever slept on. They were the first, with respect to renewable energy, one of the largest wind fleets, if not the largest, alternative energy subsidiaries in America, right? And I think, however, Nextera will always be on the cutting edge, and when people are like, oh, you guys own that utility. And so we own Nextera in size last year. We've cut down our weighting quite a bit, but it's still a large holding. For us, Nextera in the utility category, there's no other utility that even comes close. Like, and that's like, so I had the unfortunate job of my first analyst responsibility at TD Asset Management was to be the utilities analyst. And I literally take the highest energy guy and put him in the shittiest, most boring sector in the entire S&P 500. I was like, oh no, this is brutal. But I ended up finding Nextera and finding these gems that it was just incredible. Where, like, you know, utilities is such an interesting, you got all these dinosaurs, but the couple companies that are ahead of the curve, that's where the alpha is. And those guys they just cream it. Yeah, great point, Don.
What we love in disruption right now, everyone else out there, they won't touch energy with a 10-foot pole because they just say it's the past, it's dirty, this isn't what people want, ESG, so we're not going to look at it. So that's a huge opportunity for us because we're all about the supply chain to disruption and that there's going to be a transition. We've seen with Europe last winter, you can't just go from, oh, I'm burning dirty coal and now there's windmills and everything's a utopia and I'm only wearing white and I look like I'm out of a movie. There's a transition that's going to happen. So we think people are underestimating the demand for gas with liquefied natural gas and just gas demand in general, because if you want to meet those emissions targets, gas is the easiest, most pragmatic way to get there. And so utilities will benefit from that if there's more gas being burned and then LNG. And so right now, everyone's just saying we're moving away from any fossil fuel. But we think that eventually people are going to realize natural gas has a real place as we move towards this utopia. But disruptive funds, they won't even touch that. So that's a great opportunity.
Eric had a great comment. You know what uses even more energy than crypto mining? AI compute. Eric, that was good. On point.
So along those same lines, and you know, you're almost at 15% Microsoft. You know, what is an overweighted position for you? Because that's a big bet right there, right?
Yeah. So, you know, for us is, you know, we the way we think about it is risk adjusted. Would I take a Zoom to 15%? Hell no. You know, that's like, you know, but Microsoft, a 15% in the sweet spot of one of the most disruptive trends. I was like, you know, when I see Microsoft up 3% today, I'm like, this is like, that to me feels like risk adjusted return, because we think about the risk of the overall company, the market cap size, how we can fit it. And that is what really determines how big we can take it. Right. And the underlying volatility. So like what we are very focused on risk adjusted returns in DARP. You know, we're very proud. We were fully in growth last year. We outperformed NASDAQ and our peer group. We were top decile. The idea for us is that, listen, let's limit this DARP concept by definition. We're fortunate enough to get like kind of the big storm in growth right when we launched. Now, that's not exactly a fantastic environment to run growth money, but if you're doing what you're doing in DARP, that's actually, you couldn't ask for anything better, because you know you place top decile, you show that DARP works. If you have a valuation lens, that should limit downside, and it all kind of came together. But then, you know, the idea is that you provide participation in the upside in, you know, when the market's winning, and then downside protection, and it's all risk adjusted returns. So that's kind of the way we think about Microsoft. It's one of the best risk adjusted returns when you take into account the quality of the company plus the size and all of that, say, relative to a small other company.
And Apple?
Yeah. So maybe so
it's my pain point, dude. I gotta ask, you know.
Yeah, we're less excited about Apple.
It's so hilarious because that's how we ended last week. We were talking AI, and you're like, I don't see Apple. And I'm looking in our software, right? Our ETF Think Tank software at your thing, and Apple's the big underweight. right?
Yeah.
I'm comparing it to the Qs, and like you're half the weight of Apple that the Qs are. Something weird that showed up in the software though too is apparently Pepsi is in the Qs. I would have never guessed that.
Really?
So, but yeah, go ahead. Weisskopf's got a good question.
No,
Why are we underweight Apple?
Yeah, well, so yeah, we're very fortunate to have a strategist in Chris Wood, who's a kind of a a luminary in Asia. He's a big Asian strategist, and he wrote a piece this week. You guys can it's available on our Substack, grizzleresearch.substack.com. But he kind of said it best. He goes, it's kind of he was of the view that fangs or whatever, plural, whatever you want to think about it, was topped out, facing regulatory scrutiny, was not in the best position. He has done a absolute 180 on that, and he goes, this is the trade right now. You go long the picks and shovels part of FANG, and plus anyone who has that, and short anything that doesn't, which would be Apple, Netflix, right? Like that kind of stuff, right? So it kind of, FANG has now, fanged, whatever, broken apart, whatever that is. But I, he just put that piece out this week, and it just kind of resonated. I was going to tweet it out today. We just had the conference, but it just was really like, it just kind of was like, he just nailed it. It was like, that's exactly right. And so he's got a fairly big megaphone. He's a global equity strategist at Jefferies. Prior to that, he was at CLSA. He writes for Grizzle every week. So, his words resonate. So I know that, and also when you think about NVIDIA and in semiconductors and that whole world, I'm always, I find Asian analysts, strategists, those that are more connected to that side of the world, always have a real close take on it. And his biggest takeaway, it really was Chris in my ear and Scott's ear. And he said, listen, guys, there is no competitor to NVIDIA. Let's just, as you can make up a doodly do scenario of like some company coming, but as it stands right now, NVIDIA is the lead horse. And if you want to play AI, that you need to own that.
Yeah, and I'd also add it, if we, rates have been going
Sounds like he got eaten by a dinosaur.
He's at that dino. So he's on a well-trodden road that I was on from Toronto to Philly. It's brutal for reception. It's brutal. Yeah, you better grab yourself some ribs of dino burger.
Yeah, Scott, you're not coming through right now at all, buddy. You sound like Max Headroom for anyone else who's over 40. Yeah. We'll come back around, but I was also just looking at the biggest differences between, you and the Qs. Now you're an active strategy. The Qs isn't even a strategy. It's a marketing benchmark.
That's right.
But one thing that I saw that's like a big component of the Qs that's very obviously missing from your portfolio is Tesla. Yeah. And it's just always hard to have any investment discussion where NVIDIA and Tesla don't come up. So we already covered NVIDIA.
Yeah.
Why don't you own Tesla?
Yeah. If there's something I'm proud about being consensus with is NVIDIA. And the other thing I'm proud about is being proud about being anti-consensus about is Tesla. I think Scott and I both share this is that listen, the competition continues to ramp up. I think that sweet spot has been passed. I don't, and as anyone who's on Twitter gets to see and view Elon Musk operate, this guy's a bullshitter, straight up a BS artist, and one of the finest of our generation, but at the same time done incredible stuff. So weighing out a great innovator plus a BS artist, it's to us, much better bet probably, 5 years ago, much harder bet now on the EV side. But I think if we had to say, why are we, what it's not necessarily, Elon per se, and it's just Tesla. We just think the competition as a whole, that when you think about the value chain of electric vehicles, I would way rather be owning lithium. So our biggest stock last year, which is still a massive position for us, is SQM. It's lithium as a whole, but we had SQM as big of a holding as Microsoft. So we do take big bets, and SQM is one of the largest lithium companies in the world, Chilean based. And we said, listen, I know what the world like. Tesla, there's, I saw the Rivian truck. I'm like, that thing was sexy, man. I was in California. I'm like, that was a beautiful truck. I'm like, that whole Tesla sexy, that's been disrupted. That has been disrupted, but I will say what hasn't been disrupted is the fact that mining takes time. It takes environmental permits. It takes a whole lot of things that just, that literally can't, just can't be willed in, right? And we are much more, bullish on the thesis of electric metals as we are, the front end, downstream of electric vehicles, i.e. the manufacturers. I mean, let's be frank, right? There's a history of data that we can go back, which full kudos to Elon Musk. He absolutely bucked, but the car manufacturing business is not a kind business, especially as it relates to outperforming, bringing any sort of return over and above your cost of capital. It's actually been a detractor. So I'm not. There was probably a sweet spot, and clearly there was. I just don't think he has any sort of. He's trying to wield the word AI much more into his vernacular. I don't buy it, man. I'm watching what he's doing. It's like doodly do on Twitter, man. This guy's like charging for DMs. Initially I was excited. Now I'm like, I don't even care. I got a blue check mark. What do I even care about? Literally half these people are off. We're just gonna be like silos of right wing, left wing. I just want a proper FinTwit wing, that functions.
All right, Professor, you want to add some structure to that?
Yeah, I'm going to try and add some structure because the challenge that we all have to live by, right, is and I'm with you. I'm excited about innovation. I'm excited about disruption. I'm excited about technology, but how do you time that? Meaning, when you're talking about disruption, are you talking about disruption in 2023 or 2028? Because a certain portfolio manager knows the future 10 years out. Roku, right. David, just in case you're sleeping.
Got it. I was right about that from day one.
David loves Roku. It's his favorite stock.
I called Kathy Woods out on it starting February 2022 because it was her fourth biggest holding, and it was just what are they disrupting? What's innovative about that? It was crazy.
No, totally. And so yeah. So for the Dan, it's a great point. So DARP, and this is how we categorize it, right? So let's start with Kathy, and I'll name her. Disruption at any price, DAP, if you will, competitive to DARP. DAP is, DAP is a science fair project that has some unknown expiry date after 10 years. Don't know, but she's it's a TAM that's so big, ginormously big, that you'll never believe, right? But you're like, okay, wow, okay, this kind of massive thing at the end of the rainbow here, but it's always plus 10 years, right? So we believe DARP's sweet spot is between 4 to 6 years, and again, it can be earlier than that, but it can't be much later than 6 years. So that's how we look at it, right? And so we're like the way you and again, the definition of it is, well, what does that mean? It's cash flow inflection. She's talking about things that have cash flow inflection in a decade from now. Science fair experiments. We're talking about things that have cash flow anything less than 6 years and meaningful growth behind it, because that in our view, de-risks disruption. And so it gets away from that, that conversation about, not to berate crypto, but a lot of the conversations that I've had around crypto have been people just being like, what about this and that and this? And it's just so abstract. You're like, wait a minute, literally what you're talking about will never happen in 5 years. Like, why are we even talking about it? Right. And I think which was a great conversation around today, is Bitcoin is real and it's happening today. It's like, guys are using it in Africa. Like, it's being used as a medium of exchange that's real, right? Where I don't know what Litecoin can do. And the whole spectrum of, pardon my language, shit coins, right? Like, and I kind of am excited. One thing, so we are, we like Bitcoin. Obviously in our ETF, we're not playing it per se right now, just, we're not playing it through Coinbase, but it was nice to talk to Mike and how Block's playing it. But from our perspective, we are much more bullish on Bitcoin than, the broader crypto complex. Not to say the blockchain won't have, significant change. I just think things just got a little elevated there.
So can I just ask, actually, like, if you're talking disruption, the future, I mean, it's all the future. Is it really materially different to look at a 6-year versus a 10-year time horizon? I mean, to me, both of them seem kind of an arbitrary hunting, kicking the bucket down the road, and gives everybody enough time to be right or wrong. I mean, they both are kind of arbitrary.
No,
I want to chime in on this one before you go. So my previous firm, Horizon Kinetics, one of our big stories was always there's an institutional discount rate, meaning the average portfolio manager's bonus and career depends on how they did in the last 12 months. So it's very hard for somebody who works for them, for another company, to make investment decisions that have time horizons less than 1 year. So I get where you're coming from. What the hell is the difference between 6 and 10 when 90% of portfolio managers are making decisions on 11 months or less? I think that's the beauty of the indie ETF industry or indie asset management industry, right? They work for themselves. We work for ourselves. The difference between buying an active product from BlackRock versus the Grizzle team or the Title team or the Zega team, or is we actually can make investment decisions for the long run, not for an annual bonus.
That's a great point.
And I think that's a moat for smaller issuers. You and I just talked about that on the video we did, Cynthia, the captain's log, right? Like, BlackRock can't be genuine, right? Like, Vanguard can't be genuine. They can, they can tilt up and down against a benchmark, but they can't make the big decision not to own Tesla.
No,
right? They're not going to do it. They're just gonna, if their benchmark's got 500 stocks, guess what? They're going to own 490, and they're going to look pretty similar. So that, I hear what you're saying. There's for 90% of the old guard, 6 to 10 is the same, but for adding real alpha, there's a big difference between having a 10-year time horizon and a 6-year time horizon. Now, that said, the institutions would argue then you should have less than 10% turnover if you're playing themes that are 10 years out. So
yeah.
I don't know. Now
well, I think Kathy has
tackle both Cynthia and my question now.
So growth by definition. Find me any growth manager with a low turnover and top tier. Great growth managers know when to leave the party early. That's all, so there's great questions here. Our big top pick from the start of 2022 was SQM, which was a Chilean lithium producer. We took big, it was a 13% holding last year at the start of the year. We took the weighting. You know, we sold it down. It was like 6-7%. We had, I think ultimately it was at 5. We took down all our you know, we harvested our positions. You go up 100% in a year, you got to do something, right? You know, again, you know, we're still like it's still a big move, right? And then lo and behold, Chile comes in and says, hey, you know, we're going to quasi-nationalize lithium. That hurt. No doubt it didn't. It did. But like we, you know, we were at 13-14%, and we were, you know, and by the time they did that, we'd sold out all that down to 5. Yeah, so it hurt like about, you know, two percentage points or whatever, but it was compared to what we harvested last year, it's still, SQM was still a huge added value player. But again, you know, I've been in mining for quite some time. We're very we're very cognizant of the risks as related to it. We've now flipped to a much more small cap Canadian, particularly lithium weighting. We feel we have a real edge there. Whenever I hear governments are involved in any sort of production of anything, I'm like, I love that. They suck. Governments really suck at producing anything. And so for me, it just got me more pumped up about lithium. I don't care. I'll go buy the Canadian stuff. I'll go buy wherever. I'm gonna buy where the rule of law is right. You know what I mean? I got court systems behind me. I'm patriotic, kind of. You know what I mean? If Chile's not gonna play by that rule, I'll find another place. But stay long lithium. Listen, if the government's going to crack down on something, that's always a good look for the underlying commodity. Now, it may not be a good look for the company particularly, but you know, there's always an end game here.
Can I ask a quick follow about NVIDIA that I was thinking about? You know, you made the comment about NVIDIA is the story, right, in chips. So if you want to own this, or you have to own it, there's really no competition. So then what happens to the reasonable price part of the equation?
Yeah.
At what point does the disruption is more important to own than the concern about the price, or, you know, when you don't have another player to replace it with?
It's in your fourth year.
Is my video better?
Forecast.
Can you guys hear me better now?
Yeah, we can hear you, Scott.
Yeah, go ahead, Scott.
Okay. Maybe I'll just say, for us, it's always at a reasonable price. So it's really just the way you have to look at it is that if we think that this is what Mike was talking about, if you have a long-term view in it, you just think that, okay, growth is going to be so much better than where expectations are today, that the present value is actually, it's not at any price. It could be reasonable. And like, you know, Kathy also argues that. She says, okay, maybe at 100 times sales, but I know the market's going to be so much bigger than people think, and this company's going to be such a juggernaut in 10 years that it's really trading on one-time sales, which is a little harder to swallow.
Yeah. So Scott, I think we lost you there for a second, and maybe I can finish the thought. So I posted something on Twitter. I'm not sure if I can share here. I'm still, but I'm. I can talk you guys through it, right? So Amazon.
If you want to put it in the chat, it's fine.
Do you know what? I just rather talk to it. It's an easy talk through, right? And Scott, if you can hear me, you can add your 2 bits. But so Cynthia, I think you've raised a phenomenal point, and Scott's touched on the bits of that. But our view is that, listen, we are disruption at a reasonable price, and I don't think you can talk about. So if I started GRZZ and soon to be DARP, the DARP ticker, 5 years ago, 7 years ago, in 2015, and you guys said, hey, listen, you guys are DARP, but Amazon's trading at 100 times PE forward. That's not very DARPy. But I told you that this thing is different, right? And it's not like Amazon was like so I posted this this graph, and I said Amazon's forward PE hit 100 times in 2015. In the subsequent 5 years, Amazon rose 800%. So to us, that, obviously this is the art, the beauty, the je ne sais quoi of growth investing, is that you need to have that ability and vision to know that inflection that is just outside the window, whatever multiple is now, because you're growing at such a high rate. Amazon didn't, in 5 years, it did 800%. I'm not talking in 10 years. It did it in 5. So the lessons learned from that, it was 100 times forward PE, ended at 40 times. The reality through that entire period, margins rose, and it had a top line revenue CAGR of over 30% through that period. And so when I think about where NVIDIA is now, call it 45-ish times forward PE, with where we are in the AI cycle, to me, that doesn't seem as unreasonable with respect to where they stand, kind of Amazon-esque, right? There was no competitor, because guys were replying like, oh, all the Amazons. I'm like, shut up. All the Amazons in 2015? How many Amazons did you know in 2015? It's just like right now, there's only how many, and they're like all the NVIDIAs. I'm like, no, like these guys were defined market leaders. And so it's just like, I'm just like, no, I'm joking. I'm like, listen, there weren't multiple Amazons in 2015. There was one leader, but you needed to see that this is what they could do. I know very few portfolio managers, very few. And coming back to a very key point that Mike was saying, none of the ones I knew on the institutional side, these guys took no risk. They took no challenges. They didn't want, if they were on and the typical way active was run, I have a value tilt. I'm not going to own Amazon. Like it's just like, and like literally Kathy capitalized on all these schmucks. These absolute schmucks. I have a value guy. I'm like, listen, I would never go to a bar with value guys. These guys, like, if you fill a room with these fucking morons, like, I just would not want to be with these, like, get out of here. Get out.
He's gonna fit right in, but there are a few value guys that I'll go to the bar with. Meb and I were at the bar yesterday. Wes, I'll go to the bar with Wes. Tobias, Carlisle, Toby. There's some good value guys. So let's hit Dan, and then we'll give Ray probably the last question since we're coming up on the hour.
You never call me Dan. Okay, so how do you disruption is such a challenge, right? In so many respects, because you can have organic growth, but you can also have acquisition growth. How do you look at acquisition growth? Because the companies that you're long, at least right now, great balance sheets, big multiples, they could actually, do almost anything at this point, right?
Yeah. So, it's a great point, right? It's like, so my preference always is to organic growth, Dan. Like, I just don't believe acquisition can genuinely, I just believe it's smoke and mirrors. And anytime I've ever met management teams that are very acquisitive, they're in the game of like, hey man, 3-card Monty. You know what I mean? Like, it's just like, I just feel like I'm not sitting with an operator. I'm sitting with like a guy who's like, hey, look over here, watch this minute. And I'm like, what, like, what's even going to happen in the company? With the exception of, and I strongly advise anyone to look into this. My friend, my close friend, he's a head of research at TD now. He was head of technology. He's like Thomas, you got it all right. I know you have this bent, and like, listen, I'm trying not to be the value guy at the bar. You know what I mean? Like he's like, listen, I get you don't want to be the roll up guy. I know you know all the fallacies of roll ups, but you have to look at this company, Constellation Software. I'm like, what are you talking about? That is the one company that truly is the exception to the rule, which then forces you to always question your rule. So Constellation Software has executed the most fantastic roll-up strategy in all of technology. We don't own it, but it is the definition of, to your point, Dan, organic versus acquisitive. Anyone who's like textbooky kind of value orientation, say, listen, I want the operator, I want the organic guy, because he's I want the Microsoft, right? Just, bolt in acquisitions and drive growth from there. But Constellation Software, the way they run their business, there's phenomenal PM, a Canadian PM on Twitter who kind of highlighted like how that business is run. It's like they buy it at these multiples, and then they incentivize the pods to drive value. It's just like, it is the definition of like not 3-card Monty, but like, go find things that accrete value. Oh, Dan, you're muted.
No, I was screaming at my son actually because he had to let my dog out. By the way.
Rex is hungry. Ray, you're up, buddy.
Hi, thanks, guys. Yeah, question is very interesting. And again, congrats on the performance since the ETF's been live.
Thank you, Ray.
When you're looking at this, in terms of, I'm kind of going back to a question that that's sort of already been asked, but as far as the long-term view and the but with the turnover as well, when y'all are looking to move positions in the portfolio, is it always just okay, this has gotten too expensive, or is it like you mentioned with the lithium, there's a geopolitical situation or something, or is it momentum, or seeing what the market is doing generally, like recently all the FANG plus MNT have been running everything. What's sort of, or is it some of all? What's kind of the rationale as far as why you're doing what you're doing when you change positions? Thanks.
No, Ray, I appreciate that question. It kind of jump into all these topics, but in terms of what's our methodology, so we come from the institutional side, and I really I really do believe that if you don't have a quantitative methodology to start with, you just end up becoming scatterbrained, and how you implement you implement your process. So we're driven. So we have Chris Wood on the macro side, myself, Scott. We determine what buckets of disruption we want to place our bets in. Then from there, we run quantitative screens, what we call our DARP screens, that we run by sector. They're the way we look at them. We add, so because Scott, I know Scott may be on the line if he can speak, but Scott innovated. He really was one of the great innovators of growth quant, and we were known as the data shop for cannabis. We were literally producing these massive tables that people were like, oh my gosh. And Scott was just like, we're like, listen, we were quantifying the unquantifiable, and it's kind of, it's the two things. So I ran fundamental quant at TD Asset Management. It worked really well for sectors that move like consumer staples or utilities, like steady state companies. Not so well for companies that have huge swings cyclically, like commodities or disruption or technology, right? And Scott and I, when we started Grizzle, we're like, listen, let's solve for that. Let's really be data driven. If you guys follow Grizzle Research, so our Substack, grizzleresearch.substack.com, you can get a flavor for what we do. It's basically, we take the entire universe. So natural gas, just to give you a flavor, right? We have a macro, very fundamental, favorable tilt towards natural gas, but we have the total appreciation that we could be wrong for years. And $2 per MMBTU gas could be a reality for quite some time, and we could be buried. So what are the companies that are going to make it across the line? What's their margin profile? Like what the debt load, margin, and basically we take it over 7 factors. We quantify them. We quantify the entire universe of nat gas leverage names, and then we rank order them, and then we take the top decile, and that becomes our selection pool. So for us, is if you fall out of the top decile, that's not a good look. And that should be a trigger for us to look at the name. Again, that could be valuation driven, margin driven. Again, it could be an external factor that we then we proactively, again, we're not going to let the data determine. If we know that the Chilean government wants to take a much bigger load, we know what's going to happen to margins, right? So, but again, that hopefully that helps illuminate. And I have a slide deck, we can walk you guys through it all, but that we really go out of our way to just quantify growth and commodities, which historically have been very tough to quantify.
How much rotation is there in that top decile per theme, right? So you're in nat gas and you have your top performers that have low percentages of debt, high margins, et cetera.
Yep.
But those changes, and there's a GARP approach to it ish on the price too. So is that a rotating list, or do those names stay pretty consistent, or is it dependent on themes or what theme it is?
Yeah, no, it's a great point. It's very dependent on theme. So in commodities, what you find is that the at least the top 3 deciles. And again, we're not wed to the top decile. We understand that, we want to be at least above, above a midding. And so, and if there's unique stories underlying that, where the quant approach is just is a guidance for us. In commodities, if based on our 7 factors and valuations, a very core component, you got to actually break through valuation like so significantly to get out of that list. It's operations in commodities that really make the difference. And when we meet great operators, they very rarely ever fall out of the top decile, top second. So in commodities, I've always found one thing that really helps our process is that finding great companies that are great operators and just assimilating that kind of taking that DNA of understanding how they're doing that. Right? It's incredible. I've had the pleasure of who I think is one of the greatest operators in all of mining, Mark Bristow, he was CEO of Rand Gold. Now he's CEO of one of the largest gold companies in Barrick. Again, it's much too big of a company for him to move the dial, but he taught me a lot about, Rand Gold was a scrappy African gold miner. And what he used to tell me was just he's just like, we are in this just to, we have a clear mandate. We know what our goalposts are, and we're here to deliver. Rand Gold was the best performing gold company. Gold mining is a crappy sector. Most people suck.
So how do you quantify a supreme operator? So Mike and I used to be big into
we're 2 minutes over already, and I got to go to another meeting. And I love you all. Thomas is going to be part of the family, and Scott's going to be part of the family. You'll have plenty of chances to ask him questions, David. We do appreciate you joining us. We put all those links that Scott and Thomas were talking about in the chat, and we'll see you all next week. And David will be giving you a call to ask 7 more questions. Thank you very much, everyone.
No, very, very happy to answer all. And guys, a pleasure to be a part of the family, and looking forward to more of these after work cocktails, and hopefully we can all meet in person, guys. Cheers. Yep. Appreciate it.
Thanks, man. Be well.
Thank you.
Thanks
Guys. Cheers.